Hello everybody and welcome back to another video. In today's video, we take a look at the stock, commodity and crypto markets right now and potentially focus in on one of the most important levels that we've seen in some time. The SP 500 is now at what we call the defended zone or line. The thing is, the market is actually looking incredibly sick, whether we look at sector rotation and the movement under the hood of the bigger players, whether we look at the money flow and the huge amounts of shorts that are opened by the street right now in these markets, or, of course, we look to the bonds market that's telling us that things are potentially looking down. There's really not much to like about this market right now, and maybe the eventuality is towards the 3,500 zone. There is a level, though, that gives us some hope, and that is if we breach past right around here. So stay tuned as we break down the markets in the next couple of sessions and talk about the key levels that we need to be watching. So much to discuss. See you very soon. Well, welcome back everybody to the daily show here where we talk about stocks, commodities and cryptos. Let's get started by talking about some macro data. Then we'll get into the sessions and what's been happening in the flow. And of course, we'll talk about the charts and everything to do with options as well. Let's begin by discussing the last 5 weeks. Well, it was one of the most volatile 5-week periods ever. We already know that, we've seen it in the charts, but it's starting to be another one of those highly statistical events which shows us that we're in an incredibly fearful market. With fear, what comes? Well, of course, a huge amount of puts, and the current level right now, we have a large amount of puts being opened in the current market condition. Now, you'll notice this was taken the previous week. So of course, what happened after that point, we rallied a bit. A lot of these puts have now expired and many of them worthless. There's still a lot out there though. So we've got a lot of puts and we have also a lot of negativity on the street. It's kind of now or never for this market to really recover before going to the next big low, which many people, including us, have been talking about here on the channel for a little while. So bounces. Are they real? Are they not? Well, unfortunately, whenever we have a rapid bounce like we've seen recently, they do tend to be short-lived. This has led to many bull traps throughout the 2022 period. July sometimes offers respite, and it's been an argument that we've made here for a few sessions now where we've talked about, do we see the recovery train of July so that we can get a little bit of chop before probably the eventual drop later on in the next couple of quarters? That's to be determined, and at this stage, nothing seems to be following the standard data points that closely for 2022 so far. US equities have been derated at the fastest pace on record. No surprises here. Obviously, derating is a common kind of concept here on the street. The only problem is earnings estimates are always wrong during these times as well. So even if they're derating at the fastest point, often the earnings results and the estimates are generally wrong to the real reality of the situation. So don't trust so much the derating or the earnings estimates or any of these things. Instead, focus on the price action in the charts and also some of the hard data points of what are actually going on under the hood. Make sure you subscribe to the channel as well, because we will be having a look at a very important report that's going to come out this week that I think is going to show us really what's going on here in terms of the bigger traders and whether they've continued to place huge shorts over the last week or whether they're starting to reduce their short positions. It's going to be paramount to the success of trading. So I'd like to just give a massive shout out to the Discord community here, because whether it was our private stream from the last session or whether it was also the public Discord community, link in the description down below for both of those things, we had a pretty good session. While everybody else was probably a little bit upset with what happened, the gap opened on the way down, and there were so many reasons we liked the ability for the market to pick up around that level of the 50 or the 40 zone. We'll take a look at that later. But basically, we got the movement up. It ended up going flat, and of course then sold off throughout the day to do the pullback. Now, it's not the sell-off that's the worrying component, but there certainly was some good trades to be had in this session here with the movement towards the gap fill. And I think a lot of people in the community were pretty happy about that. And congrats to everybody. Always join if you're interested in seeing more about those types of things. Let's now talk about what actually happened though in the sector rotation. Well, some interesting signs here. Metals, energy, gold all got dumped. What got purchased? Utilities, a little bit of solar. Solar continues to do quite strongly here. And we also saw XLP, XLV, the defensive sectors coming out and being purchased through the session. Now, this has started a trend that we've seen here in recent days. Look at the top performing sector, utilities. Look at one of the other top performing sectors, staples. What's that telling us? The market's gone defensive again. Just like a few weeks ago where we really thought around the idea that technology was seeing an increase move, and it certainly did. That was the best rally. We also cautioned this week against that being the continuous move. These have been incredibly fast switches in the market where they're going from saying, oh yeah, we love the technology side to, oh no, we don't. And it's very important you understand which market you're in, because if you're in the wrong one, then you can get really beaten up by being in the worst asset at that time. Let's talk about the VIX, the volatility index here. Look, it's in the middle of nowhere. 28.69, elevated very highly. A lot of people that don't know what the VIX is, it's the fear index, as many people call it. And it's important to look at, but it's not giving us too much extra information. What is giving us a lot of information, though, is the US dollar index. That is the DXY. Here, I just put it against the SP 500 so you can see it. Notice the kind of changes of trend. When the dollar index has been going down or sideways, the market has been rallying. When the dollar index has been weakening again here, the market has been rallying, weakening, rallying, and now we're rallying, weakening. So what this is it's a really good ramification, or just justification, I guess, of showing the money coming out of the system and into the system, depending on whether big funds are purchasing or selling the stock market. Overall net, they're starting to turn the most bearish I've ever seen. Huge amounts of shorting going on in the market, and they're not closing those shorts at a very fast pace throughout this rally. I've spoken about that this week, which is why I said it could be a bull trap, and we've talked about that concept a few times. This is the important factor though. What if the US dollar drops in the next couple of sessions? Well, that would be a lot of welcome respite, because if the US dollar drops, we've seen a strong correlation with the S&P 500 that's almost been kind of in lockstep or very close together. Something that I would be watching on the charts. Another good bit of news in some ways, though it really just means that the economy is kind of sick, has been the US 10-year and 2-year yields decreasing. A new low formed. Fantastic. That means that you would think, in essence, that the market could potentially rally. But at the same time, what is this? Is this some kind of sickness in the economy, or is this just yields and, of course, inflation decreasing? Some of the stats we've had coming out recently have shown that the inflation could be kind of dropping marginally, but still at incredible elevated levels. Some good news for bull traders, and that's why we're getting to this critical point for the next 24 hours, is that the dollar index on the 1 hour time frame changed its first time frame change of trend. So while we do expect a rally here, somewhere around 105.20, or even where it is at the time of this recording, could be areas where the US dollar will actually drop. If they do drop, that could be a good signal, or at least a good coinciding signal with the US stock market being purchased back up, because it really is now or never for these markets. Let's move over now to the US oil market here, and we'll talk about oil. We've been correct on this one. Oil did drop. Change of trend, of course, occurred. What happened? Oil dropped off a cliff. OPEC also agreed to slightly, marginally, I think, rise or raise the amount of barrels coming out. That's good, I guess, for the economy in general. Of course, it may lower or go to lower some of the costs of everyday life, but it's still not a very positive chart in terms of the way that oil is trading at. 105 a barrel, never a good thing in the economy. It looks like more expected weakness would be here for US oil. If you take a look at the daily now, that's two big red candles. Basically, you'd be looking for a new low and then a potential test of anywhere from 98 all the way down to about 94. Demand destruction in play in some ways here on these charts, and it's worthwhile watching. Gold, not so good, yeah? It actually did something pretty interesting. So we saw the bit of news that came out, and gold actually went to rally heavily, probably picking up a bunch of supply at that point, and I think the street started dumping gold into whatever example they had. Now, I have talked about the bullishness of gold here. We are entering into one of the better months of the year for gold, which is July. I do like to focus on those things, and obviously I will still be looking at gold on the channel, but at the moment, it's at a point where you wouldn't really want to make too many decisions on it. It's kind of at the demand level, it's underneath. There's a chance it goes all the way back down to 1789. There's also a chance it randomly just bounces up. You can see the trend line here of the last couple of peaks and how it's acted. So we're going to have to look for more information on gold. The manipulation is fierce on this metal, and I don't see enough people entering in long, that is the bigger players, to really say that the July rally is coming for it just yet. Let's talk about some key indications that are looking bad for the US market. One of those is semiconductors versus the S&P 500. Another good way of kind of looking at the risk on, risk off nature of the markets. At the moment, very much the risk off nature, and the market has basically almost made a new low here on semiconductors, showing the weakness in the technology sector, particularly one of the biggest high flyers. I mean, this has been for a long time one of the best performing sectors in the market, but it had so much, maybe too much bullish gain on it, it's going to potentially give up a lot. I'm really not bullish on the semiconductors at the moment. I know a lot of people are, but I'm super not. And this chart can show you why. XLY, XLP, another poor performance for this. This helps us gain, again, risk on, risk off, but more from a rotational basis standpoint. We were feeling okay about risk. Obviously, we talked about risk coming on. We liked risk still here. And then all of a sudden, we start to see other signals that were telling us that maybe it was a risk off environment. We're still at the low, but it doesn't look too healthy. Let's move over to bonds now. Now, this is LQD, it's corporate bonds. To explain this, really, you need to understand how bonds really work the best. But I will say this about bond markets. It's understanding that there are two components that go into bonds, interest rates and risk. Right now, interest rates are very high. Of course, that's a huge component when we think about it of where the market's at. But when you think about where the market was at during 2020, a lot of people will look at this and they'll say, oh, look, it's the same price. Yeah, but we're also talking about a risk component. Over here were interest rates very low? Yes, they were. Therefore, this was almost all risk in the markets. Over here was interest rates very low. The answer? No, interest rates are much higher. So while the interest rates are dropping, is the bond market really putting on that much? The answer? No. This is not good. And while bonds do look like they're at a critical kind of level, realistically, we just went through a new low on some of the indications I use. Not a positive sign for the medium term here for the markets. And I'll continue to keep you updated on that. But I don't like it when bonds and US stocks are not agreeing with each other. And when the bonds are going bad, I usually pay attention. Tesla here, yeah, it's just kind of hovering around the zone. Look, it did a good job to hold itself. Obviously, I think Tesla is like a proxy to risk on in some ways here. If you trade, let's say the SPY pickup on the S&P 500 is rallying, and then you have a Tesla position which you want to enter because it's rallying through this point, the S&P 500 is giving you the green light, well, then this is not too bad and maybe it'll work out. I think breaking past 690 is going to be a big deal if it can do so on the Friday. If it does, then the next stop for it could be as high as like a 730. So Tesla is more of that kind of proxy. But for now, we know 620 is demand. And if the S&P 500 starts to fall, I think Tesla will just fall in line with that. And then we'll find out whether we can hold the base. At this stage, I'm not too sure if that's going to occur. Let's look at some of the other reasons why this looks pretty bad. We talked about the DAX. This is the German 40 market. And a lot of other markets around the world are showing a lot of weakness here. We had the rejection candle, the double tweezer, not a good signal. And then, of course, it went bang. 1 day, 2 days, 3 days. We're in this support at the time of recording, and we're going to be there coming into the Friday session. You can see what's at stake. It's kind of now or never. We get through this zone, what's going to happen? Where's the next drop-off point? Well, unfortunately, on something like the DAX, it could be as low as 11,600. That's not going to be pretty for anyone that's out there. And I'm sure many bears are like licking their chops thinking about the fresh salmon that they'll be getting when it gets down to this level because, yeah, it's pretty low there. Nasdaq held its own as best it could, created a bunch of dojis at the last 15-minute kind of trades of the day. It filled the gap on the way that it created down. So it had that gap down, bulled up, filled the gap. So that's basically efficient in this case. For the market to recover, you got to get through this zone here. This is it. Right there is the recovery area. And let's move over to the S&P 500 so we can see it in a better form. This is the doji that was left on the daily, but I'm going to use the futures market just to explain this level here. So here's at the time of recording, the level we had chalked up yesterday, 37.40, 37.50. You'll notice we're back there now. That was a very good level for a turnaround. It did turn around and it bounced up to the 38.20. Now the problem is, where is the supply? So if you're a person that looks at supply and demand kind of dynamics, we broke the first level, which is here. We've pulled back now down into here. It has to kind of start to go right now. It really needs to start putting in some legs. But to change on the higher timeframes, you must breach this distribution area because, of course, this area here ended up being the short zone. So we really need it to rally. And until it gets, I know sadly enough, above 38.40, it's not changing the trend on the 1 hour, the 2 hour, those types of timeframes towards the upside. At the moment, you've only got like 5 minute, 15 minute, those types of charts with you. So it's kind of got to move up. And if it doesn't, what's the next stop for this market? Well, I think the problem is it's going to be pretty low. If you put on a weekly S&P 500, and we'll just do that together here. We change this to a 200, make sure it's set. 200 there, simple. We go to a weekly. Where is the weekly? It sits here at 35.10. Previous resistance highs back from September, October, and November on these markets. If we then zoom it out, look how the market loves its weekly 200. It's liked it a lot in the past, and this is a key level that I believe a lot of buyers, at least Wall Street buyers, may change their commitment in these markets. Possibly we reach that zone. What do you guys think in the comments down below? Let me know right now, because that's going to be a very important area. The other reason we thought the market could potentially go up in the previous session, that you can always apply, and remember TA number 1, options and this type of concept well into the number 2s, would be the maximum pain. Now you'll see 386 maximum pain. Well, that didn't happen, but that was much higher than the current market price at the open. Remember, we were in that 370 ranges. Also this, the random amount of puts that were sitting at 380 for the options expiration on the 30th of June. Now this was a fairly big deal. The market goes up to this level, and I don't have the updated data, but I assume a few of these were closed. And at the same time, it actually ended up hitting the perfect max pain, I believe, for the QQQ. Coming into Friday, what have we got? Well, no real clear zones. We've kind of got this middling area, which would all be fantastic for the street to close at. Maximum pain's technically 383, much higher. Maybe if the bull rally starts to happen, that might make you feel better. But at this stage, it's all about this kind of like 370 put and all about this 390. Do I use these? No, I don't use them predominantly. I just use them as a little bit of goalposts. Should I see the correct technical setups and then think, okay, maybe then the rally could go into these levels. That's the type of thing you're thinking about. So stay safe out there on this type of stuff. It's super important to do so. For Bitcoin, well, it's doing its own thing. Another liquidation event over the previous 24 hours. It's still in a massive setup, I believe, between key supply and key demand. I don't really like touching it at the moment. It's not that predictable, and I think we come back to this as we go through it. And of course, we'll always be focusing on Bitcoin, but no updates there in the last 24 hours. For the news ahead, there is one big bit of news, ISM manufacturing PMI. Expect that to be the pivotal kind of bit of news, 10 a.m. New York time. That's going to push the market, whether it goes to a new low or whether it looks fantastic, and suddenly the market goes, hey, I like this bit of news. At the moment, the bigger signals are pointing towards the down. The trend is looking pretty nasty in terms of that weekly, daily trend, and it's really down to the small time frames making a huge shift here. And once we get above that 38 kind of 40 area on the SPY, it looks like the rally will continue probably past that previous peak and get into our big trend line. Thanks so much for watching. If you enjoyed today's content, remember to subscribe, smash that like button, guys, and we'll see you in the Discord communities and of course on Twitter @FXEvolution is our handle. Bye for now.